Well, stimulus still the only game in town. Like an addict, market participants just can't seem to break the habit. Pick and Pay bottles it, Cell-C borrows more time from bondholders, and Google does a little bit of evil, maybe a lot of evil. We'll find out. So with your view from the market, Rob Tywell, Portfolio Manager at Sasfin Securities, and Victor von Reich, Portfolio Manager at Citadel. Kick us off, Rob. Another awfully thin day's trading. If you look at market turnover, 14.3 billion. The all-share up marginally by 0.2% at 55,271 points. What stands out?
Yeah, relatively lackluster day. I think in the mining, you saw a turnaround in the platinum stocks. We saw Northern's up 2.5%, Implat's 2.5%, Amplat's caught a bit as well, and then ARM, African Rainbow Minerals, also up 2.6%. So we saw a turnaround in the platinum. That was what really gave a turnaround to the resources. But banks, again, flat. And then retailers caught a bit of a bid today. Again, you saw that was a nice positive after Pick and Pay's numbers. Tiger Brands is up 3.7.
Clicks?
Libstar 2.3, Clicks 7%, AVI 2.3%. So the retailers are all picking up and finishing positive on the day.
Victor, is that on the back of those Pick and Pay numbers? It did reveal that the impacts of COVID-19 and the various levels of lockdown meant 2.8 billion rands worth of lost turnover. Despite that, it still managed to grow top line at a very healthy 2.6%. So it does seem to indicate that retailers, there are essential services are bouncing back quicker than most.
I think it's exactly that. We saw it with the SPAR results as well. So I think investors are sort of looking through these results, seeing business models that have been able to adapt in COVID, moving more to online, focusing on more profitable shops, smaller format stores, aggressively attacking the cost base. And I think it's sort of very reassuring to investors that the retailers, and especially the food retailers, have been very resilient in what's been a very tough 6 months.
And Rob, what we have seen is a huge push to grow the online side of the business, and it was always part of the strategy. At every single results, there's a slide or two dedicated to growing the share of market in e-commerce and online, but we're still talking very low single-digit numbers. And then COVID-19 happens, and all of a sudden, everyone is scrambling to get online. You saw ShopRite very successfully roll out its 60/60 offering, perhaps catching Pick and Pay a little bit flat-footed. What do you make of the bottle deal?
Yes, I think they needed it. I think they needed a quick move to get delivery done for themselves. I think you try to expand your own logistics team, but sometimes it just moves too quickly. And I think they needed to do that transaction. So I think it's positive for them. I don't know how scalable it is. When you buy a small business like that, how much more scale they can get and how quickly they can move it. But I think it was a good move by them. And it's also brings margin back to the business.
That's certainly a question I'm going to be putting to CEO Richard Brasher shortly when we talk about the results and his plans for online and how he intends on scaling it. I've seen a lot of those little delivery bikes with the 60/60 branding all over them. I haven't seen too many of the Pick and Pay versions. Maybe they're doing it unbranded, but that would be strange. That would be a lost branding opportunity. So lots to get our teeth stuck into there. And then globally, Victor, there's only one game in town at the moment, and it's still the stimulus roller coaster with Nancy Pelosi and Stephen Mnuchin set to slug it out today. The odd thing for me is that it seems a fait accompli that we're going to have stimulus. So it's a question of when, not if. Why is the market so fixated on this?
I think post-COVID, with obviously the damage that it's done in terms of employment, the damage that it's done to businesses, investors taken the view that liquidity is all important, and with the Fed being able to provide stimulus and liquidity, both monetary and fiscally, that's obviously become very important to help sort of markets through this very difficult patch at the moment. But you're absolutely right. There seems to be a very close correlation between our risk assets perform and news flow around stimulus. And at face value, that the two bills don't look very different. There are some nuances, and and both parties seem to be converging, and I would therefore agree that a stimulus looks all but done. The question, I guess, now is just whether this happens before the election, with Nancy Pelosi giving a 48-hour deadline to the Republicans, which seem to be sort of holding it up in the Senate, or whether this happens after the elections. I think in the greater scheme of things, probably doesn't make that big a difference whether it happens now or after the elections, but obviously a lot of politicking happening at the moment, partisan politics at play. So politics, unfortunately, is dominating headlines for now.
And it will for the next 2 weeks at least as we run up to that election. Speaking of politics, there's a lot of politics at play in the antitrust suit against Google as well. It's been one of those bipartisan issues, Rob, with both Conservatives and Democrats in agreement that tech companies have become a little too large. When you start talking about the ability to sway and swing elections, when you start talking about the ability to erode the foundations of the fourth estate, the way Google ads and Facebook ads have done, you look at the way the Australians have approached this and the way they regulated a fund into supporting the media, for example. Fascinating time to be talking about how you regulate tech when tech has been the runaway success sector over the last 3 to 4 years at least. What do you make of this latest move? Is it a threat to that bullish long-term narrative around the FANGs?
Well, in the past, when any type of company got to about 40 to 46% of the market share, there was always regulation around it, whether it was big oil or other industries over the last 100 years. Around 46%, and you start to get regulation. So I think that was coming. The difficulty here is that they let these companies get that big as well. I mean, every single company that virtually gets listed gets bought out by Google or Facebook. Instagram is not Facebook's development. They bought that company. WhatsApp they bought. So, they allow them to get to this size. It's quite a difficult business, though, to regulate. So it's going to be interesting to see how quickly they can regulate it, and if these court cases will just go on indefinitely for years and years and years. It won't make too much difference to these businesses. But it's going to be an interesting next few weeks when we see what happens with the Department of Justice.
We've already had a foretaste of how our competition authorities might approach this when new mergers come before it. There's a special door on the side and they say, come here, ma'am, come here, sir, and we'll talk to you if this is a tech merger. We saw it with the We Buy Cars Naspers potential acquisition last year. That was prohibited, and that wasn't based on the market share that Naspers had at the time. Naspers was just looking to get into that market, so they're looking at the future impacts of competition as well. Very interesting indeed. Coming back to this issue around the lack of turnover, Victor, in the South African market. I mean, it's very commonplace now to see turnover numbers of between 12, 13, 14, 15 billion odd when they were north of 20 not too long ago. And the Afrox delisting as well. Is this just another sign of the death knell for local equity markets? Are we just being consigned to a bit of a backwater market?
I think if you look at sort of the past decade, and I know Keith McLaughlin has done a bit of work on this, we've seen, just in terms of the number of shares on the local market, a decrease of call it almost 2% year on year. We've seen some unbundlings, but that doesn't really create new companies in the true sense of the word. I think there's been a number of reasons. Obviously, companies globally have stayed private longer. That's not really an issue in South Africa. It's more regulatory issue as well as sovereign risk. And we've seen a lot of pressure in the small and mid-cap space where liquidity is dried up. And it's not a recent sort of phenomenon. We've seen this at play for the past 5 or 6 years. And it really makes it very difficult for companies to stay listed. In terms of onerous regulation, whether you're a small cap or a mega cap, you have the same onerous regulations that you have to comply with. Companies don't get the ratings that they potentially deserve, and ironically, sometimes trade at a discount to some of their unlisted peers. That makes it very difficult to raise capital, and there's very little price discovery, specifically in that space of the market. And I think that obviously leaves companies with little choice but then to delist, as they look for other funding sources. Obviously, also if you look at the top 40 index, and you just disaggregate that by super sectors, we've seen that same pressure at play in the so-called SA Inc. stock. So unfortunately, a lot of these delistings are companies that have fallen victim to very pedestrian GDP growth. And unfortunately, that trend looks set to continue, although there's been a recent sort of uplifting in some of the share prices from very depressed levels. But the bottom line is we need sustained GDP growth. That's really the only way.
That said, though, a lot of the private equity funds, many international private equity funds coming in, seeing value and perhaps seeing something that institutional investors are not seeing at the moment. I want to move on to the other big story today, Steinhoff, and it's a piddling amount, 13.5 million in terms of a fine from the JSE here. Rob, when you look at the hundreds of billions of rands of shareholder value that have been destroyed due to this accounting fraud. We don't even have to call it alleged accounting fraud. We still need to see the full PwC report. And you've got CEO Louis de Preer saying in a statement that the group is pleased that the process has been concluded. Talk about misreading the mood of the room.
Yes, I mean, it's surprising that the JSE can only levy a fine at that level. You would think that it would be related to the size of the company and the loss that the company made. So it should have been tiered. I'm totally surprised that that's a maximum that they can fine a company that's lost 3.9 billion euros. So I'm sure they're pleased, Steinhoff, that it's over, because it was only 13 million rand.
It's a travesty. It really is. That is in no way, shape or form justice whatsoever. And we still see Marcus Jooste swooning around the Ferncliff estate down in Hermanus. Let's move on to the other shocking news of the day. Perhaps not unsurprising, because it comes from the SABC asking Netflix viewers to pay TV license fees. Can you believe this, Victor? Why on earth should a business be paying for its, or a competitor be asking its competitors to pay for its services? It is ridiculous.
Yeah, I think the short answer is it shouldn't. The SABC doesn't look like a viable entity. If you think about the sort of offering, obviously COVID has materially hurt, the finances of the SABC, which is very reliant on advertising spend. In terms of collections, we know the story there, where they've battled for years to collect on fees. But I think with the service offering broadening significantly and globally, also in South Africa, I think the users have voted with their feet. Media is consumed in different and new ways, and unfortunately, it will leave a lot of companies behind. I think that the SABC, in its current shape and form, is not really equipped to deal with that changing landscape, unfortunately. So I think it's interesting times there for the SABC.
Every business would love to have their competitors pay them, but that's just not how competition works. You've got to stay relevant, you've got to invest, and you've got to innovate. That's certainly not words that are associated with our public broadcaster. Victor Van Reach, Portfolio Manager at Citadel, and Rob Tyrwell, Portfolio Manager at Sasfin Securities, with your view from the market.